Welcome to the Options Income Blueprint Weekly Report. This is Michael Schulman on July 5th, 2022. A reminder, we have a trading session coming up. You may actually be listening to this after our trading session concluded and the alerts went out for the new trades. As always, I'll review our trades and results from last week. And there's something quite important. I ask you to pay attention in those results because we took a loss. I'm going to discuss in depth what we did with Teladoc, because I got the emails that we closed on Thursday, took a small loss, and then we wouldn't have taken a loss if we closed on Friday. But I want to review exactly why we did that, and I also want to go over the market, which is opening week this morning. Two new trades last week, some cash coming in, some cash going out. There was a net return of 0.3%, and it's important. You're going, wait a minute, you only had two trades. You may be new to listening to the update or new to Options Income Blueprint. We have a whole bunch of other positions that we didn't trade, that we rolled, and then we generated a lot of cash, and here they are. I've begun to space out some of the selling of calls, so we have an orderly cash flow week by week, and we have a certain amount of position management that isn't broken down and clustered into 8 positions on one Friday. And these rolls in a bear market, owning shares and selling calls is a tremendous way to generate cash and income, which is what we're all about here. And the bottom line, when you put the new trades and the closed trades and the Teladoc loss, which was small, and everything together, our net rate of return was annualized. On an annualized basis, was 18%. In a market that's down more than 20, that's a run rate. That's not what we did in 1 week, obviously. I'm happy with that. I still want to shoot for that 26.5% a week. But caution and capital preservation and freeing up capital for the next trade are all very important, and times you have to do certain things that bring that rate of return down. And you could see how overall performance worked for us, breaking down by the categories of trades. So for those of you, and I don't get as many emails as I used to about this, who don't want to roll trades, you want the action, and you want to trade on Tuesday and leave on Friday. That's not the way you trade this or any market, actually, and that's not what we do here. The idea here is to generate, based on a foundation of capital, a certain amount of cash every week, to think very long term. Markets come back, Apple ain't going bankrupt, neither is General Motors, and so forth and so on. So the bottom line is to think long term and trade every week to generate cash, and to get wary of, but to not get hung up to destroy your trading instincts by what your portfolio may look like on a given day. So the reason your portfolio may look like something you don't want to look at on a given day are the movements in the market. The S&P continues to trade down. A whole bunch of things continue to go on. Ukraine, continuing weakness in an understanding in the market of how the Federal Reserve is going to react. The market is baked in a 0.75 percentage point increase at the end of July, another one in September. We see that in the way bonds are trading, and now there's a concern about recessions. So when we close here, I'll talk about earnings, because that's really what we need to prepare ourselves, our capital for, our trading for, is when earnings come in, starting for us next week are the important companies for us. And this is all in the context of this was the worst first half of a year since 1950, which was the beginning of the end of something called the Nifty 50. And, Xerox and Kodak, they're non-players anymore of any importance. I mean, Xerox is a successful company, but certainly not a Google or an Apple. And it's the worst first half of the year for stocks since 1970. But if you flip the switch, your lights go on in your apartment, and you may not want to pay $5 for gas, but you're still visiting kids or grandma or what have you. So in 1970, we were kicked off by the beginning of inflation that ended up at 19%, or 17% with interest rates at 19%. Saudis had taken over their own oil fields, I think, in 1969. So you're looking at a tenfold increase in gasoline prices from 29 cents a gallon to near $3. And if you inflation adjust that, you can imagine how it is you're looking at 1971, and this is a curiosity of history. The United States went off the gold standard in the same quarter or the same 5-month period that the microprocessor was invented. And so it was quite something compared to today. So the comparisons aren't fair except for numbers, and they create headlines for those yakkadoodles that are on the television and radio and what have you. The bottom line for us is the market's direction is uncertain. The issue for us is volatility and how we are able to trade it or how we're able to avoid it. To that point, let's take a look at when we should be avoiding certain potential volatility and taking losses. Now, the reasons for taking losses, you no longer can hit your goals. You're not going to get to where you want to be with the capital tied up in a position. Time to go. The fundamentals of the company have changed. One of the hidden stories of Tesla is that a lot of their margin, a lot of their cash or profits that were on paper came in from the selling of offsets, and because the government had a subsidy program, per vehicle, it's offsetting carbon emissions and pollution emissions and what have you. And one of the stories is, if you take a look, and Michael Burry, the guy from The Big Short, was talking about, well, they've pretty much exhausted them as of General Motors, and for Tesla, it's a much bigger deal. And so when the fundamentals of a company have changed, you have to take a look at it and say, what am I going to do? Now, there's also how Wall Street values a stock. So a lot of post-pandemic crashes. We've seen a lot of the hot pandemic stocks come down 80%. Yes, they were trading hot among Wall Street traders, but it's also, will 50% growth continue? And even when 50% or 45% growth continues, such as in a company like Crocs, sometimes Wall Street says, no, we want to revalue everything and bring the stock down. And if that valuation metric is unclear, you have to stay away. And especially, this is the next point, it's especially true for the summer, when liquidity and premiums dry up. In the master's program, I'll be going over the bullpen in a few days, and the bullpen will be larger, and there'll be some things that I will be saying you can trade these on your own, but they may not be liquid enough for us to trade. And of course, you put together short term. You may love an Apple or a Crocs or a General Motors or what have you, but if you take a look at the chart and you take a look at the market is trading and your own goals, they just may add up to saying, no, I'm going to get out and I'm going to take a loss. And now our goals, we aim for roughly the average annualized return. This is not a portfolio, but the average annualized return for one, we do 100 trades, 105 trades, 110. The average nets out to around 20. And with current levels of volatility, we can push that hope. I mean, that's a goal. And this is not overall portfolio performance, but as I've argued here and when we're live in a webinar, when you're doing 20 or 25% a year in cash, you're typically going to outperform the market over time. And the key two words there are over time. Now, we took a loss in Teladoc. And let me explain what the company is if you're unfamiliar. It's a network of doctors and experts on a software and video platform, but it also licenses the platform itself. It's a chaotic market, and nobody doubts the durability of the market. I mean, we went from that 63-fold increase was about 800,000 Medicare visits in 19 and 53 or 54 million in 2020 because of the pandemic. And that sticks. I think everybody's provider that I know of offers telehealth if you want it. But the winners aren't clear. The big guys are introducing their own capabilities. Zoom has a HIPAA compliant, meaning it conforms to government regulations on privacy. So there's a lot of competition that concerns Wall Street. And it was a classic pandemic stock. Now we're getting into the trading. The fundamentals of the company are very sound despite it not making money. But it was a classic pandemic stock. It exploded in value for obvious reasons. And it topped out around $300, and you can only, and it's crashed since then. And we trade it opportunistically, not every week, but opportunistically when we sell options. So sound company, not necessarily profitable, very, very, very volatile, which is very important. And there's something there that I really, really liked in terms of the potential growth of the company. It's also a big company. We're not talking about a little startup. It's many hundreds of millions of dollars in revenue. 60,000 We're not talking 500 experts, like 60,000 people and thousands of customers, institutional customers. So here's the trade. You can read it for yourself. So we took a loss. The bottom line is at 26 cents. And we rolled it, and it's important that you understand we rolled it. This started as what I call a silly put, where the put strike price is at least 10% out of the money. This was 14. We closed to avoid the Fed meeting. Then we went back in, and we started moving that strike price up. And in retrospect, based on results, not on the decision at the time, which is so important when you're trading, got probably too aggressive. Maybe should have stayed at the 30 and gone to the 30 and not the 32. And we ended up with a certain amount of cash in hand because we'd had a net debit, we had a paper loss, wanted to get past that paper loss, and then we had to close it. So why did we close it? Was testing support. Support was at $32, clearly. And had been moving down faster, as you would expect from a highly volatile stock than the broader market. At 32.75 and support at 32, one big swoosh in the indexes down could pull the stock down below a technical trading point. And even though it might come back in a week or two or even a few days, I did not remember. I said I want to trade this anecdotally. We got in a net debit position initially. I really wanted to move on. It's not profitable, very volatile. Earnings are coming up, uncertain market. They're just times to say it's nearing support, one big sneeze in the market, and we're out. Okay, so it reversed on Friday. And we would have closed out of the money, so we took a loss instead of having a $6 win. But, and here's the difference between making a mistake in decision and the decision leading to a mistake. There's a difference. And the issue here is you have to make the correct decision at the time. There's a cliche, forgive me for reusing it, bulls do well, bears do well, and pigs get slaughtered. And if you're trying to make the most from every single trade all the time and you're not sticking to your goals, it means when you hit your goals, you're not closing and you can give back profits or end up with a loss. Or when logic says that the downside risk of being stuck in a stock that's going to tie up my capital, and not just for a few days, but because this is volatile, it's somewhat speculative as a stock, not as a company, I just have to take my lumps and move on. So the decision was the right decision. The result was not what we would have desired, obviously, both in taking a loss and missing the possibility of making a few bucks. So I want you to emulate, when you can, this kind of decision-making process and understand that taking a loss is based on reason. It's based on I want to free up my capital. I don't want to be in Teladoc for another month, and so forth and so on. So to that point, this upcoming month, you have a situation next week, starting on the 13th, Delta Airlines, which announces a week or two before most of the other three big airlines, United, American, and Southwest, and the banks start announcing on July 13th, and their management comments will set the stage for the market making decisions about where it wants to go. Now, all the other things that are going on, Ukraine, crypto, there's non-financial but agitation concerning recent Supreme Court decisions, and there's a nervousness in the society and the country in general that traders are not immune. I'm including professionals, so be aware of that. And July is going to be a big month. And if the Fed language stays neutral, then I think people will start to say the Fed will not raise 3/4 of a point past September. They may not even do that in September. It may go down a half a point. You may see a slight rally in the bond market, which would be good for equities. But the bottom line is earnings and management is going to focus on, are we going into a recession? And the answer is yes. Is it a statistical recession? Yes. Is it a real recession where it hits employment? Probably not, except for the lowest income workers that serve the travel and restaurant business, and not even construction. And is it going to be a recession that's a profit recession, which is what Wall Street is most concerned with? And that's a recession where you have contracting profits. Profits as a percentage of GDP, and I said this last week, went up for a generation, on never seen before, and that's ending. So not only would it say if the S&P 500 trades at 17 or 16 times trailing earnings or current earnings, if earnings go down, of course, and you stay at 16 times earnings, then the market goes down. But then the market want to be more conservative and say, I only want to trade at 12 or 13. So there's still a significant bearish sentiment, but with volatility being where it is and the ability to trade earnings anecdotally, then we have really good opportunities in July. This is not the time to go to cash. This is the time to free up capital, as we did with Teladoc, and get ready for some great trades. So I'm going to discuss that next week. It'll be Monday. We're not closed. And I'll be discussing how, for income and being conservative, what is the best way to trade earnings. And the one hint I'll give is you don't trade them before earnings. You trade them when it comes out, after they come out. This is Michael Schulman. Thanks for listening.